Bloomberg Audio Studios.
Podcasts, radio, news.
Jeffrey Currie joins us, professor of price theory at the University of Chicago, a small firm downtown. Great interview yesterday. John Farrow with Mr. Solomon.
Saw that, yeah.
It was like, it was like piercing. It was like
they were in Versailles.
Wherever, Currie lit Versailles with his energy knowledge.
Yep.
Jeff Currie joins us now, Energy Pathways at the Carlyle Group. He roots for the Baltimore Orioles. Jeff, copper. I got to rip up the script here. We're not doing oil, we're doing copper. 2011, 2021-22, and now another surge way out over 3 standard deviations. What's different this time with a surging copper?
One, the investors have finally bought into the view that China is not the only game in town for copper. That's the main thing, is people finally wrap their heads around, yes, the property market in China can sink and you can still be long copper. And positioning is full force right now. And I think that if you look at what's different now, it's the willingness of the investor to embrace this market despite the fact that there's a weak property market. And that's what happened in 2021 and those other time periods that you were talking about, is people started buying into it. Then all of a sudden the property market weakened. They got too scared and pulled out of the position. I think there's a couple things that make this different. Is one, they've now seen that copper demand can rise in the face of a declining property market. It's up 6% right now in a very weak property market. But also, they've seen that the government's willing to spend infrastructure on green CapEx. There's a lot different.
Is there a utility overlay as we see utilities surge because of electricity build out? Does copper go up with the AI enthusiasm?
Oh boy,
100%. I'd like to say, AIs, chips and copper. You need the chips, but then you need the electrical wiring to be able to power those chips. And one of those chips, the NVIDIA chips, the GPUs, consume as much power as the average American household. So you're going to need a lot of grid connection to be able to accommodate that type of growth. And, what is the bottleneck for that? It's copper. So all roads lead to copper, whether if it's military spend, AI data centers, green CapEx, they all point to copper.
You couldn't have copper in a million years. I wouldn't have guessed it. So what do I know? But so there's the demand side of the equation, Jeff. You just highlighted a number of sources of demand. Can you explain to us kind of the supply side of copper? I don't know anything about this. Where does copper come from, and how's the supply?
It's one of the last of the good old-fashioned commodities you got to dig out of the ground. Think about oil with shale manufacturing, aluminum manufacturing. You got to go out to very remotely located, geographically restricted places like Chile, Peru, the DRC, Mongolia. It's only located in a few places around the world, though in Zambia in that. And a lot of those places are incredibly difficult to get into. Then you got to dig deep. Your ore grades have come down. It can be anywhere from 12. You take, Ivanhoe's big mine in the DRC. It took 26 years to bring online. So there is a big commitment to be able to get the supply online, and you have strong demand. And everybody's been sleepwalking into this, even though they've been told about it. We started calling copper the new oil back in 2021, and it rang on deaf ears. Now it's finally people are perking up to the story, but it's going to take years to bring this.
I've been medicated, Paul. Ask one more question, and then I got to do microeconomics with Professor Currie.
All right. So while we have you, Jeff, here, talk to us about oil here. I'm looking at. I like to quote WTI crude oil. I'm an American. I love the guys down in Texas and Oklahoma and all those crazy people. $79 a barrel here. What's driving oil these days? Is it supply? Is it demand? What are you focusing on?
All the commodities are being driven by the same demand forces. It's late cycle, business cycle, in the sense that you can think of 2022 and 2023 as being your classic mid-cycle pause, where you raise rates, higher energy prices, the system slowed down. It regathered steam, consolidated around the higher rates, and now we're chugging back off into the second half of the business cycle. That's when you want to own oil and commodities. And it's about the level of demand stressing the inability to supply. That's why all of these markets are going up. The vast majority of them are in backwardation. It's all your typical, end of cycle type of bullish structure that's playing out here. And I don't see this oil being any different than copper or some of the base metals.
And now, folks, Drive Time America, early in the morning, your microeconomics segment. Jeff Currie, we just were honored to have Richard Portis, a giant of English economics in London Business School, he was kind enough to give us a story about studying under John Hicks a few years ago. I want to talk about going back to copper and to China and all the emotion. Jeff Currie, is this a shift in demand along the curve or an outright shift of the curve that has a permanence?
The outright shift in the curve is permanence. And think about how much of that's occurred since 2021. The military spend, whether if it is munitions in the U.S. to the tune of $95 billion, $100 billion in places like Germany, and then you throw in the AI data centers on top of that. That's all an outward shift in the demand curve. So, that's going to lead to structurally higher prices. And I think the question is, why will it lead to structurally higher prices? Because somebody's going to have to be crowded out here. There's not enough supply to go around to everyone. Right. And so we're going to find out where demand destruction actually occurs.
Jeff Currie, thank you so much. That segment of Microeconomics with Bloomberg Surveillance brought to you by the George Stigler Foundation, Chicago. Jeff Currie, thank you so much with Carlyle there.